Hey, what's up, y'all? I wanted to do this quick video. We got a big week happening in the stock market this week. We got earnings season for the banks, right? So all of the big banks are releasing their first quarter earnings. So we got the JP Morgans, Goldman Sachs, Bank of America, JP Morgan Chase, AIG, Citibank, etc. Right? They're all releasing earnings this week. And it's kind of difficult to play these stocks individually. So what I like to do, especially playing options, I like to buy ETFs and exchange traded funds. And this exchange traded fund that I'm looking at right now is called XLF. So X-Ray Lima Foxtrot, right? It contains all of those big banks that I just named, plus many more. And so it's expected to boom because all of the banks going to have earnings. Some banks going to be earning, some banks won't be earning. So a better way to a safer way to play this is to just buy the ETF, so that way you can have, all of the, you can experience the run up pretty much. And so I like playing ETFs, especially around this time for something like the big bank earnings, because I don't really play the individual banks. But yeah, it's just something I wanted to kind of to touch on. Now, me, I play options. You know how I told y'all, like options give you the right, but not the obligation of to buy 100 shares of the stock, right? It gives you the leverage. So that's how you make money playing options. Matter of fact, let me show y'all the some plays really quickly. So I'm looking at contracts that expire the week of April 16th. So the last price of the stock on the XLF ETF was 35.15. This was when the stock market closed. Now, this is called the options chain. So all of these prices right here, these numbers, these are strike prices. The strike price is the price that you're betting that the stock is going to be at on, or that's going to be at or above by the expiration of the contract. Now, you don't have to hold the contract till the expiration. It's actually not recommended that you do that unless you're exercising your right to buy 100 shares of the stock. But that's a little far than what we're going to do right now. So right now, I want to just the first options contract that stands out to me is this one right here, this $35 strike right here. And the reason this one stands out to me is because I see on Friday, it had a volume of 18,942. That means by market close on Friday, 18,942 contracts have been bought and sold for this one specific strike price. And then you got 190,000 contracts still being held. So people are still holding 190K contracts, right? Then you got a delta of 57, which means there's a 57% probability that this contract will expire in the money. That means the contract will expire with value, right? It also means that for every dollar increase the stock makes, so if the stock goes from 35.15 to 36.15, you will get a $57 increase in your contract's value, right? The contract also has a theta of $3. So that's a good thing too, because that means theta is time decay. So it's for it's how much money you're losing that's being burned off of your contract for every day that you're holding it. So that's a nice low theta, because I don't want money being taken out of my contract anyway. You got a vega of $2, which means that for every 1% increase or for 1% increase in implied volatility, you get $2 added to your contract premium. For 1% decrease in implied volatility, you get $2 deducted from your contract premium. So this is a good thing. This is a good thing because another thing. So the contract is only going for $45. So the ask price here is $45. Now, I know a lot of people are probably saying, why is everything in cents? Because remember I said that, options give you the leverage of 100 shares of the stock. So the multiplier for everything here is times 100. But an easy way to simplify this, because I don't really like math, is you can just move the numbers 2 spaces to the right of the decimal and it'll give you the number. So it's $45. So everything I was saying, like even over here. But yeah, I like this contract. This one has the most open interest and everything. So I like what I'm seeing here. So if XLF moves, if the big banks have a big week, we're going to get a lot of movement here. I don't want to miss one thing though that's very important. On the put side, one thing about options, you can bet against the stock. You can bet, that if you think the stock is going to go down, you can bet against it. Now, so big banks may have a horrible week, right? And you have right here at this $34 strike, you got 5,200 contracts being held. And so it's 5,200 in open interest. So there are 52,000 contracts that are being held for this $34 strike. So there's somebody there. These are people betting that the contract that the stock will be below $34, at or below $34 by the expiration of this contract, which is the end of the week. So you got people betting against it also. I mean, again, I'm not trying to hold the contracts long. If I get into this, I'm gonna buy a few of these. I'm gonna hold them for a little while, let it run up, and then I'm getting out of there, but I'm just saying, it's just something to play. Now, remember I was talking about the implied volatility, about how a 1% increase in implied volatility would take the contract's premium up by $2, or if it decreased by 1%, it would take the contract value down by $2, or subtract $2 from the contract value. I want you to see something else. If you go up a few strikes up to this $38.5 strike, this one has 126% in implied volatility. So, and this one also has a bigger of $2. So let's say hypothetically, that's a big number, but let's just say this number was smaller before and it jumped up by 50. You just added an extra $100 to your contract premium. So, but implied volatility can be dangerous also. If you get left holding this bag, and because the implied volatility happens when there's an expected move, right? So let's say you're expecting something to happen and it happens, whether it's good or bad, whether the expected result occurs or not, the implied volatility is going to decrease. And then a lot of your contract premium will be ripped from your contract. And that's called IV clap, so just be careful with that. But if you're a part of my Discord group, we will be live on Zoom tomorrow, and we will be going through all of this along with other stocks and things. So I see y'all tomorrow. If you're not a part of our Discord group, you can join. Or just just have fun trading. Talk to y'all later. Let me know if y'all have any questions too. Just leave them in the comments. I like questions. Peace.